And in particular, starting with the QRA announcement on November 1st, it became very clear that Janet Yellen was going to back off the market-based tightening and the long end tightening. And then that was reinforced by how Jerome Powell has positioned it back in November 1st, and then again at the meeting last week. And so you put that together, and it's like, look, the overall picture is a stance of easing. Now, is easing when we've had an inflationary spike and unemployment's at secular lows and stocks are making new highs, is easing really the appropriate thing to do? I saw recently that, we had in the last 8 weeks, the biggest easings since either the bottom in 2009 or the bottom in 2020. But heck, like, you got to go with what's going on, and they've decided to ease, and the markets are going to respond in that.
Well, when you say easing, though, you're speaking on two different types of easing. There's the Fed, and the fact that instead of actually selling bonds, they stopped selling bonds. And then there's Powell and his pivot, which is now like the onomatopoeia thing. The Powell pivot was powerful, and combined, it basically forced equities to go up in value, since there was no, the wind was at their sails, not at their head. Is that basically what you're saying?
Yeah, I mean, if anything, I think equity investors will quickly forget or not notice the fact that long end bonds at the same volatility of stocks are up more since November 1st than stocks are. So what that highlights, this is not a story of, it's actually not repricing stronger growth expectations in the economy, which is interesting, and I think creates actually a forward-looking opportunity. What's been priced in is a big easing that's been reflected in the yield market, and that's flowing through almost directly into equities. Now, I think that's setting us up for an interesting opportunity, in particular in the first quarter, because what that means is we've had a big easing. Stocks have actually trailed high volatility or long duration bonds. My guess is we'll see a flip of that, because a big easing is the sort of thing that's good for stocks, but particularly bad for bonds.